Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to another episode number 50 of Vantage Point with True North Wealth Partners. Number 50, woohoo! Can't believe it. Time goes fast when you're having fun. We've been doing these for a while. We've enjoyed them. Today is Wednesday, January 21st, 2026. And unfortunately, Andy can't join in today. His folks are having some health issues and procedures, and my parents are still hanging in there, but it's been a struggle, but we're getting there. And then also Eric and the crew. I'm solo today, is what I'm trying to say. So no one can join us, but we'll cover a lot. This will be educational, very informative. We'll do a recap of last year somewhat. What's happening now, and then the projections of what's to expect for this year in 2026, which is most important. All right, folks. So what I need to do for Stratus to be sure all in compliance and good riddance here, I have to read this, so just bear with me here. This information has been obtained from third-party sources who are believed to be accurate, but cannot guarantee its accuracy or completeness. That's if I hold up papers, graphs, things of that nature. Also, everything I talk about, asset classes, products, diversification, things of that nature. The following information is general information only, not intended to be specific investment advice. It's important to consult a financial advisor who understands your individual financial situation prior to making any investment decisions. And then lastly, when I talk about like my beliefs, this is just me today. So it's Eric Susi talking. So it's my opinion. I believe things of that nature has no bearances to anybody else within Stratus or our company here at True North. It's all me. Okay. Thank you. With that said, we'll get right into it. Last year, it was sort of the tale of two halves. The beginning half had a little tariff tantrum, markets went down. If you recall, we had about 19% pullback in the S&P, March, April, May-ish. Those were some challenging times, and we had about 19% drawdown in the S&P 500. Overall, we had 5% pullbacks in the S&P 500 last year, which was above normal, above the average. And then we also had two greater than 10% corrections in the S&P 500 last year as well, which is, again, above the average or normal. So that was last year. As far as growth was still a leading factor pretty much until November. Once November hit, then it started diversify out, meaning sector rotation started to occur into more of the small caps. Emerging markets did well last year as well. So that had started last year, November, December, and into this year in 2026 in January thus far. So, overall, our portfolios, Andy's mines, we did all right. We took less risk. We provided a smoother flight than the appropriate benchmarks. We lagged just a tad. And remember, the turtle versus the hare, who wins the race? The turtle. So yes, okay, we lagged a tad, but we provided a smoother flight and experience last year in the markets overall. So I wanted to touch base on that. In regards to maybe transitioning a little bit more into this year, where we're at. So the GDP Nowcast just came out today. Okay, this is from the Federal Reserve Bank of Atlanta, January 21st. For the fourth quarter of last year, the GDP Nowcast is estimated to be 5.4% for the fourth quarter. A tenth higher. It was 5.3. Now they're saying 5.4. Great. These things move all over the place, so I'm not really putting a lot of credence into this. But the point is, it's a stellar fourth quarter and above 2% or so, which is great. So that's sort of where we're at with GDP for the fourth quarter as a latest estimate. Heading into inflation, we talked about. We use HedgeEye, obviously. We use SIM, Stratus Investment Management, still on the calls weekly, provide great information. It's awesome. So they utilize HedgeEye as well as NDR and some other resources. But going back to HedgeEye, which I've been using for over 10 years, and also Scott Bessent, who's a Treasury Secretary, he has been using HedgeEye for over 15 years, and he's getting what I'm sharing with you now. He gets these when these get updated from HedgeEye. And it's also shared with the Trump and his economic policy holders. So with that said, you can see they called the low back in April and went higher up, to September over 3%. came back down, lower, lower, lower. Okay, and then that's what's nice about Hedgeye. They try to skate to where the puck is going and front running the Fed and the economy overall based on their own proprietary nowcast projections, which are stellar. Best I've seen, and I've been in this industry a long time. So since 1991. So with that said, that's why I take credence to what they do. The projected nowcast here for for January's inflation, which will be distributed in February 11th. So January's estimated nowcast is 2.47, which is lower than the 2.68. So again, there's a dispersions higher and lower, as you can see, but they're coming in right now, currently, hot off the press as of today. This just came out, again, revised, a tenth lower, was 2.48, now it's 2.47. So that's what's projected to be published on February 11th. So again, everybody else thinks it's going higher per se. So not baked into the stock market. So wanted to point that out. Some other things too. Inflation in general. Nathan, our producer, does a great job. He'll hang on to this. This is price changes. Okay. So as you see this and study on and lock in on this for a little while, because there's a lot here. This is inflation since 2000. So 2000 through almost the end, September 2025. So almost through the end of last year. Again, this is coming from a Visual Capitalist. And this came out published January 13, 2026 from them. So look at this. From 2000 to 2025, hospital services up 275% inflation. Incredible. Cost of goods and services. College tuition, 196 higher. Childcare, 185 higher. Medical care, 129 higher. Housing, 111% higher. Food and beverages, 104% higher over the past 25 years. New and used vehicles up, but it's only 25% higher, so that's a positive. Furniture only up 9% over 25 years. Clothing only up 2% over 25 years. Everything else, cell phones down 43, toys down 74, computer software down 75, and our lovely big TVs down 98%. You gotta like that. So this really puts it in a nice summary. Because people, the narrative now is affordability. Okay, nothing's been affordable for the past 10 to 15 years, quite frankly. But this sums it up for the past 25 years. And just from 2020 through 2025, even though inflation has fallen to around roughly 2.7%, prices are about 25% higher than in 2020. So there you go, 25% higher in 5 years. That says a lot right there. And that's because of COVID, the M2 money supply, the government spending got out of control. So both sides of the aisle can take blame, but a lot of it was really since COVID going further. 25% over 5 years. So hopefully you enjoyed that piece. Let's talk about maybe projections. So we another entity we use, First Trust. They do a fabulous job as far as summarizing, giving us information. This is just a talking point that they produce. So of a Bloomberg survey of 21 equity strategists found that an average of 2026 year-end pricing target was 7,555 on the S&P 500. So 7,555 is what the average ending year price for the S&P 500 should be based on 21 equity analysts. Bank of America, JP Morgan, yada, yada, yada. And that's basically a 10.4% increase. Then the 6,845 closing price for the S&P stood on 12/31/25. So basically, 7,555 is the average annual of these 21 analysts. Again, roughly 10.4%. Last week, I had a meeting with a Goldman Sachs rep. He was here at the office and going through that. Their Goldman Sachs prediction of their analysts said the S&P target is 7,600. It's a little bit higher than the 7,555. All right, so that's great. I'm glad. Hopefully I'm wrong. I'm a little bit more sanguine here. So about my projection, okay, it's a dart in the air. None of this really matters. But right now, as I see things, about 7%. So the S&P 500, I see 7% at the end of the year. Hope I'm wrong. I hope everybody else is correct and the markets are higher. But there's a lot out there. So with that said, I guess things to be aware of, you saw already yesterday, a one-day sell-off. Okay. You have the Davos, the World Economic Forum, all the corruption that goes on. It's pathetic here in the United States and worldwide. Light, sheet, and steel. It is what it is. But people are calling it out. So the truth is finally getting exposed via the sunlight. So thank you very much. And the fourth turning is what we're in. So fourth turning is by Neil Howe. He's part of the Hedge Eye. He wrote the book back in the 90s. Look it up, Neil Howe, fourth turning. You'll love it. You'll educate yourself on what we're in. We're in the midst of it right now. He's predicting it's happening right now. It will go through the mid-2030s, like mid-2034, 2035. So it gets worse before it gets better. So that's what the uprising stuff we had, summer of love, all that great stuff, yada, yada, yada. So today the markets have already flip-flopped. So the markets have pretty much recouped what they lost on Tuesday. So that's how fast these markets move. So I just want to sort of set the table there and be realistic about what's really going on within the economy and the markets, et cetera. So with that said, let's move on maybe to tips of the month, okay? Tips of the month, there's a lot going on here. So I'll hold this out. And then we produce this. It comes through a vendor that we use, but we could have these charts, 2026 numbers. I'm just going to highlight a few things. Reach out to any of us. We can email it to you, PDF it to you as well. So just things to be aware of for contribution limits for your 401k. Contribution limit for 2026 is $24,500. Okay, it's a little bit higher. Catch-up provision for 50 plus, if you're age 50 or older, it's $8,000 more. And another catch-up provision, if you're age 60 to 63, you can dump in another $11,250. Okay. For IRA contributions, if you're under the age 50, it's $7,500. If you're over the age 50, it's add another $1,000, so that $1,100. So therefore, the total, if you're over the age 50, is $8,600. Okay, so it was $8,000 last year. 2025 is the max. Now it's $8,600 is the max for 2026 if you're over the age 50. Otherwise, it's $7,500 for 2026. Contribution limit for 2025 was $7,000 if you're under the age 50. A lot of charts on this. The COLA, cost of living adjustment, we already talked about that. It's 2.8%. So for those on Social Security, you got that bump, but also everything else went up too. Medicare premiums, Part B, that's 202.90. So 202.90 is the Part B premium. Then you have the IRMA. For those, watch out the IRMA. If you make too much, you'll get surcharge with that. There's a lot with the non-itemized, the One Beautiful Bill, and seniors get a $6,000 eligible deduction, charitable deductions of thousands for single, $2,000 married filing jointly. Over time, you have an exemption amount. Okay, so no tax on tips over $25,000. Okay, or below. Car interest loans, again, up to $10,000. But for married filing jointly, if you're under $2,000, you can deduct the $10,000 in interest. If you're single, it's $100,000. So there's a lot of great information. The estate planning, the annual gift exclusion is $19,000. So $19,000 is the amount you can give per person per year to whomever you wish. So that's one important chart. Also, this is neat. This came out from Hedge Eye. They have the Tier 1 Alpha that I'm also subscribed to. Tier 1 Alpha, I'm on their calls along with the Hedge Eye every day. They provide great information. So this is neat, and Nathan will hold this up too. It talks about the buyback blackout period, okay, in earnings. So right now where we're at, this was published out on 2 days ago, January 19th. We're near the peak of the blackout period. So right now, 78% of the companies, of the S&P 500 companies, are in the blackout period. That means they can't talk, they can't do any buybacks, anything like that per se. So, and then it peaks out right around the beginning of February. And then as earnings are announced, you can see the earnings in orange. So a lot of earnings are coming up. And then after that, then the buyback blackout period then disperses and goes a lot lower. So it's just a way to try to keep insider trading at a minimum, but it still happens, as we know, just like a Pelosi. Anyways, you can see all that. They made an ETF fund off of her, so I thought that was interesting. They just follow whatever she trades in, and I thought that was pretty interesting. So that's another tip of the month there. So with that, I guess we'll end on lovely charts. So there's a lot of charts here to go through. Again, Nathan will hold us up. I'll speak through this. So the bond market volatility is called the MOVE index. So it's a volatility in the bond market. The average is 86. And right now, yes, it was through yesterday, which had that spike up about 800 basis points, so 8% move yesterday. It jumped up to 67, so it was a lot lower than that. But like I said, the bond market went up yesterday and it came back down today. So that's how fast that moves. But it's well below. That's why the markets are still hanging in there doing well, because this is a canary in the coal mine. When you have the bond or move index move higher, it's a cursor of what to come in the stock market index. Also, the VIX, volatility index, your CBOE VIX, it's 30 days looking forward out. And again, it was subdued. It was around 15, and it spiked up to over 20. On Hedge Eye's call today, it talked about it's happened only 5 times, hasn't moved from 15 to 20 in the history that this has been tracked over 30 years for the VIX, okay? So it doesn't happen often, but yesterday was one of those days where it moved from 15 to over 20. And remember, 0 to 19 is the investable bucket. 19 to 29 is called the chop bucket. Back and forth, back and forth. That's what we're in, or probably out of today because the markets are back up. And then if it's above 29, it's called the F bucket. And you know what that means. Nobody makes money. It's about losing less. So pretty much the VIX has been in calm and control. Pullbacks last year, I talked about that. We had 6 last year. The average is 4.6. So far, 0, 5% pullbacks. I do expect more this year than last year. So as the year's just beginning, so strap in. 10% pullbacks for the S&P. We had 2 last year, none this year so far. I expect that to occur as well. Again, the average is 1.2. Stock market valuations, as you can see, where we're at today, pretty much we're overvaluated. So you can see the little diamond, dark diamond versus the red X a year ago. We're pretty much elevated across the board. PE, price to book, price sales, price cash flow, dividend yield. So we're 2 standard deviations above. So we do anticipate some pullbacks coming in over the relatively soon, meaning over the next month or so. S&P 500 growth, you can see earnings, the historical average is 7.7. Latest is 13. So the call, I'm hoping, and I'm hoping for around a 10% or so earnings. A lot of Sims and other folks in our research department are more or greater than that. The streets in the teens, 15%. So I hope they're all right and I'm wrong, but that's great. Just keep it above that historical average and keep the growth going. So U.S. economy growth, okay. GDP, we talked about that, was 4.3 in the third quarter. It's now projected, as I mentioned, 5.4 is the projection for the fourth quarter. So great. We don't see it being that strong, and throughout 2026, it will be lower than that, but still positive, above 0. If you recall, when you have 2, quote unquote, negative consecutive back-to-back quarters, that's technically when you're in a recession. But that's, times have changed. I'll leave it at that. Leading economic indicators, the current, we're at 98.3. Okay, so we're only minus 3.3% away from getting back to positive. So this has been negative for so long. I don't even know if it works anymore. But again, it's in the teens, 12, 15 different indicators that are leading the economic indicators, but they're still underwater. But technically, when that happens, you're in a recession. Same here, the 2-year, 10-year spread, it's 0.7. The average is 0.84. So again, the times when we're underwater below 0, they didn't call a recession, what have you. But the point is, we're positive, which is steepness in the yield curve. That means the short end is, as the Fed cuts rates, that gets lower and lower. The long end is steepening. The 10, 15, 20, 30 year steepens, which is overall a good thing. CPI, Consumer Price Index, okay, core, that excludes the X food and energy. Okay, it's 2.6. So you can see where the CPI, PCE, this is the Fed. They like to get this. The goal is a 2% target personal consumption expenditure. So again, that's that. The gold, you can see, we had the commodities, low correlated asset classes last year. We're still owning them this year as well. We have commodities funds. We have individual gold, silver, things of that nature. Among other things, we have the buffer ETFs to provide that smoother flight and ride for you. So gold, as you can see, going back, has done very well, going back to 2007. So 2007 through 2025, or excuse me, January 20th, I should say, gold has performed 546%, and S&P 518. So gold's outperformed the S&P over that time period. It's incredible. So luckily, we've owned it for the past few years. I've had well over 200% plus return, gold and silver. So we did well. And again, we do contrarian things. You buy things when people find them out of favor, and you sell them when they're getting near their highs. This is a nice chart to look at. 2025, you can see communications. These are sectors within the S&P 500s. So index, so sectors, communication, technology, industrial. You can just sort of see how those were the strong points for 2025. And you can, energy was only 8.7, consumer discretionary, consumer staples, Clorox, things of that nature was 3.9%, real estate was 3.2%. And then this year, 2026, it sort of flips. So that's just how fast things can move and the broadening out of the markets. That's just a nice correlation of diversity. That's why the upshot with that is you want to be diversified across multiple asset classes. Wage growth, you can see, has pulled in. A lot of that was all fluffed and by the M2 money, the printing press that happened, which was crazy. So now we're getting back to reality, about 3.6, still positive, doing great, still above the averages of 3.3, so that's good. Mortgage rates are coming down, great, 6.1. Need to see a 5 handle for that mortgage industry to take off this year in 2026. Hopefully it's the low 5s, mid 5s by sometime this year. Gasoline prices have come down. You can see where it was back in 2022, well around over $5. Now it's 2.78. National average there. The average since 2009 is $2.97. $2.97 per gallon, is the average price since 2009. And right now it's 2.78, $2.78 per gallon. So that's a quick overview of that. So I gave you some analysis of the markets. Yeah, they still be bumpy. No recession. We don't predict a recession this year, just more market volatility in both directions. There'll be more rebalancing coming. We've done some already. We'll be doing some more, basically more in February as we see that through Sim and as well as Andy and Eric and myself as well. So you'll see some tweaks happening to your portfolios. Any questions, obviously, please reach out to us. We do appreciate you. Hopefully you enjoyed the new year. And then this year starting off, buckle down. We have a little weather storm coming this weekend as well. So you hang in there. Appreciate you. Have a great year. We'll talk again in the next quarter. Thank you.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website.
Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. Opinions expressed in this podcast are for general information only and are not intended to be specific investment advice. It is important to consult a financial advisor who understands your individual financial situation prior to making any investment decisions. Some of the information contained herein has been obtained from third-party sources which are believed to be accurate, but we cannot guarantee its accuracy or completeness. The information should not be regarded as a complete analysis of the subjects discussed.